Morning, everybody. I'm Tim Kaladz. As she said, I'm a reporter with the Globe and Mail. So I cover business, finance, capital markets, broadly speaking. And in the last, I'd say probably year, but really the last 6 months, since the start of the year, that has involved crypto. I often, people often say cryptocurrencies. I actually prefer to think of it as a broad crypto world because, as we'll probably get into, even the regulators themselves aren't quite sure of how to characterize these things just yet. But we've got a great panel today to discuss all the issues because I think pretty much everywhere you look these days, you see crypto stuff. I watch Formula One racing. Crypto.com is now the lead sponsor of Formula One. I was just seeing that there's going to be Super Bowl ads this year where crypto exchanges in the US have bought ads. Matt Damon is now the figure or public face of Crypto.com. There's an ad out there. So it's really become a thing. But before I go on, I will get each person to kind of introduce themselves very quickly.
Thanks, Tim. My name is Evan Thomas. I'm the head of legal for Wealthsimple Crypto. Wealthsimple Crypto is one of the various products offered by Wealthsimple, a financial services company here in Toronto that offers investment, spending, tax products. Wealthsimple Crypto is our crypto product, and it was the first crypto trading platform to be registered under Canadian securities platforms, under Canadian securities law rather. And so I head up the legal function as it relates to that product.
Thank you, Tim. Great to be here today. My name's Anna Bedore. I'm a partner in the financial services group at the law firm McCarthy Tetro. I also co-lead the fintech practice there and work with a number of businesses in the cryptocurrency and blockchain space. I'm delighted to be here today.
Thanks, Tim. Eric Richmond, Chief Operating Officer at Coinsquare, which is a digital currency platform that started back in 2014. Think of it more as a native crypto platform that's been around for a while in the space, offering trading of 29 plus coins. And I'm also the Chief Executive Officer of a company called Tetra Trust Company, which was kind of incubated by the company, but is now an arm's length party from the company, which is the Canada's first qualified custodian for digital assets.
And we've also got somebody digitally. Neil, I want to give a quick rundown of who you are and where you are.
Yeah, hi, good morning, everybody. My name is Neil Schramm. I'm here in Miami right now, and thank you for having me. I'm a partner and the head of operational risk for a firm called L1 Digital AG. We're based out of Zurich, and we are an asset management platform that specializes in cryptocurrency and digital asset investments. We invest across currently 3 funds. It's a venture capital approach, so we do liquid venture and pure venture through various fund vehicles, meaning we invest in other hedge fund managers that invest in crypto, and we do direct investments into the market through venture capital investments. And again, focused on crypto, we do tokens, we do equity, we do hybrids, but broadly across the space. The firm was founded in November 2018. That's when we launched the first portfolio. That's where we are.
Sounds good. So we're trying to keep it as conversational as possible, just because it's more lively that way. And I guess I would start off by saying, probably about 6 months ago, I had this moment where I was looking at markets, and this is broadly speaking, this is also around the time of kind of meme stocks and all that kind of stuff. And you start to kind of wonder, like, am I missing something? Do I not fully understand what's going on here? So I really did the work, particularly around crypto, and I read the white papers, and I've really kind of dug in. And I think I quite understand now the underlying infrastructure or the idea behind it, and that would be, to use kind of a broad term, blockchain, and the idea that kind of everything can be authorized, identified, and coded to track it. I'm generalizing here, but there seems to be 2 competing things out there. There's kind of the underlying infrastructure, and then there's also kind of this market behavior, whether you call it currencies, trading, whatever, however you want to think about it. And admittedly, that's the part I don't quite understand just yet. But there are people who truly believe. Some of you probably are those people. So I was wondering, broadly speaking, why crypto? And maybe I'll start with you, because I think you had recently kind of changed jobs. You kind of really went all in and used to be a corporate lawyer yourself, or a litigator, I think, and then decided to go all in on crypto. Why was that? What did you see?
Well, okay, you have to go back a few years. I think it was maybe 2016 or so, where I became interested in crypto, the technology, the market, the culture, on a personal level around that time. And then over the year, I started to see it creep into my professional practice as a lawyer. I was in private practice at the time. And that was the last time we saw a lot of market activity around crypto. There's a tremendous amount of interest in the space, a lot of investment coming in, arguably a lot of speculation. But I was really intrigued by not just the technological aspects, but really also the legal aspects as a lawyer. Because I see crypto as something that really challenges a lot of the presumptions of our laws, how our laws enforce, how we regulate, how our regulators enforce the regulations that exist. I just found it very intellectually challenging as a lawyer. And so I continued to make it part of my practice over the last 4 years. It's been, and it was a considerable part of my practice within a sort of broader practice focused on litigation and technology matters. But then in June, I made the switch from private practice to join Wealthsimple. And I think it's really because, I look at this as, for a lawyer, there's maybe a once in a generation that something comes along, whether it's a market development or technological development that really disrupts the law, which is not something that gets disrupted all that frequently. And so I wanted to make that a bigger part of my my professional endeavors. And 5 months in of making it my full-time focus, I can't say I have any regrets about it, just because it really is, I think for me, very intellectually challenging as a lawyer. And I found the technology and the culture and the behavior very fascinating.
And building off that, maybe Eric, I'll go to you, because you've been in the space for a while now. I guess where I get mentally stuck at times is I don't quite understand, and I'm saying this all objectively. Like I said, I truly want to understand why is the disruption necessary? And the reason why I say that is because a lot of the people that have gotten into crypto, particularly lately, this isn't in the past few years, you see a lot of kind of Silicon Valley type VC money, et cetera. And so you're kind of seeing this blending of of these worlds. And there were a lot of people in the early days who saw kind of what I would call the purity of the system. And a lot of people will say it almost in math terms. They'll say it can be very beautiful. And now so much money is rushed into it that it's not quite clear what the motivations are. So to you, who's someone who's been around it for a while, what did you see? And how would it make things better? How would it make the system better?
Yeah. Well, I think when you started off and kind of describing your view of cryptocurrencies, I think the one piece you may have inadvertently missed is the fact that it removes the need for trusted counterparty or trusted intermediary, right? And that removal of that party is really what has driven this adoption. And if you start applying it to multiple different business lines and services and different, even as simple as games, right? It opens up an entire world. And what I really mean by that is, if you think about, well, we already have, I can go on the internet, I can go on, there's Shopify and PayPal and all these businesses, and I can use them to conduct transactions online. Well, but that you're still relying on the traditional infrastructure, right? You're still relying on Visa, you're still relying on the banks, you're still relying on all of these services. And what crypto and distributed ledger technology really allows you to do is leverage that without that counterparty in the middle. And that really has a lot of value. And so the first application of that was really crypto to money, blockchain to money, right? And that's what Bitcoin really is at its core. Obviously, people call it now as like an alternative to gold as well, as a store of value. But now you're applying it to multiple different industries and asset classes. And that's where it also gets really exciting. So that's why you see the additional adoption now into all these different types of services, and it's really disrupting everything from gaming to DeFi, which is several decentralized finance, to multiple different asset classes across the spectrum.
And I'm saying this to try to help people who haven't done the work, who are still pretty new to this, but maybe want to understand, because it's kind of become this buzzword. And I'll give you guys a personal anecdote. we had a baby right before lockdown 18 months ago, building a baby in a new bedroom. We had a drywall contractor in, and I guess he heard me because I was working from home. I was on the phone, and afterwards I got off, and he was like, what do you do for work? And I was like, oh, I'm a business journalist. And first question immediately was, what do you think of crypto? And that's kind of a running thing in our industry where it used to happen with taxi drivers and house prices. And you could arguably say the same thing happened here in Canada. We had a huge cannabis, which truly was a bubble. A few years back, cannabis was everybody was talking about, and it was the kind of situation where like my buddies who I play fantasy football with would be like, oh, my golf bro told me about this, this stock or whatever. And it kind of feels like we're at that level. And so I think there is still that disconnect out there, particularly with the retail investor, as to kind of how the digital assets that are being traded quite frequently connect to this world. So maybe using your gaming example or something, you can, whatever you want, like make that bridge for us.
Well, I think the key is that, like any new space, a new asset class, there are obviously these stories of issues, rug pulls, scams in the space, right? But the industry has really matured. There are tons of resources out there to learn as a retail investor to learn about the products and services, right? There are disclosures, right? Like let's call them the CDAR style disclosures of these coins, to really understand everything behind it, understanding the teams, understanding the white papers, understanding everything behind like how everything operates. And so that's where you can really get the comfort to be able to use this technology. Now, to bring the example back to like gaming, the big thing right now, the growing space right now, obviously with the news of Facebook changing its name to Meta, there's been a huge explosion now in the metaverse, which really at the end of the day is it's kind of similar to the play to earn games, which are really big now, are growing in the crypto ecosystem. And really what it allows you to provide is it's quote unquote disrupting these games, because you have games such as Call of Duty and Fortnite and all these games which are free to play, right? And you have all these things that you can buy within the game as the more you play it, right? And so what these tokens really allow you to do in the game is now buy those tokens on a secondary market and then actually earn them within the game. And so you actually have real tangible value, not just from playing, not just from like within the game, but also externally from the game, which is really unique and interesting. And that's why they're called essentially play to earn. You're earning money to play. Again, now you don't need to be a professional esports athlete to generate money. You can actually be someone in your basement, for example, and generating return for playing these games.
Maybe go to you. I'm not sure if this is kind of privy to your world, but one of the things I was thinking about, almost as a personal investor, was as I was saying, I got comfortable with the idea, or I could understand better the idea of kind of the underlying infrastructure. Is there a way to invest in effectively the infrastructure rather than the currencies? And is that something kind of your shop looks at? Because it feels like, and I could be totally wrong here, that a lot of the VC money, so to speak, has kind of gone into the underlying, I hate to use the word again, infrastructure, but the actual kind of utility of it all. And a lot of the retail money has kind of gone after what we see in the day-to-day market and kind of in the trading. Is there a way to kind of access that, the underlying world of it all, that kind of is at the center of it all?
Well, one thing that's not well understood is that in many cases, the tokens themselves, not all tokens, but tokens themselves are in fact the infrastructure. It's not something that's very well understood. And this is, there's a select, say, group of tokens. Now, these are not necessarily the retail tokens that are prone to a lot of speculation, and are really accessed by retail investors. But there are tokens that are, they create infrastructure, as a gentleman pointed out, related to gaming. There is a company, for example, called Flow, which is out of Dapper, which is based out of Vancouver. And they have one of the more prominent coins right now that is not necessarily what we'd call a retail trade, but serves as infrastructure for NFT creation and ultimately gaming. And some of their larger relationships are with the NBA. They have something called Top Shots, and recently with the NFL. Now, I'm not here to promote Flow and Dapper necessarily, though for transparency, we are investors in that company and in that token. But that is an example of more retail investors being able to access infrastructure per se. And the same with the traditional equity market, for example. If you look at GameStop as an example of something that is prone to very high speculation, and I would say as a kind of a trade or a meme is prone to speculation from very, very retail investors. In crypto, the same as in the equity markets, there are all different classes of investors. Some are much more retail. Some are retail, but let me put it this way, say more thought into the way they invest, and read the white papers as you do, and look at the tokens and try to understand the economics of the tokens and how they serve as an infrastructure component to the future emerging financial system. So the answer, of course, long way about it is yes. I would say, though, that investing in the platforms, as you talked about, in companies specifically, it is very similar to the traditional VC market, where these are private transactions, private companies that are typically funded by venture capital firms of all kinds, including ours. And we invest directly into the equity of companies that could be, say, custodians, banks, options houses, market makers, things of that nature, banks that I mentioned as well. So the interesting thing about crypto is that it has a democratization component to it, and I think this is what is the centralization component plays into, which is that retail investors can get access to the future Apples of the world, where in the past, before Apple was a publicly traded stock, for example, only VC investors can get involved in that. So again, the same with traditional investing markets, traditional asset classes, equity, bonds, that type of thing. There are a range of opportunities for all investors, and I think it's important to recognize, as I pointed out at the beginning, that tokens themselves are in fact infrastructure. They're not just instruments created for speculation, but tokens, the type that we invest in, look at, actually do something. They do something very specific in a very specific ecosystem. And again, I need to emphasize that because it's easy to take away from these type of manias that tokens only exist for purposes of speculation. And that couldn't be farther from the truth.
And to that
some
point,
tokens may. Yeah.
So I was just going to say, to that point, I'll share something. This is for the audience that it was actually very helpful to me to understand what effectively he is saying means. And this was given to me by a corporate lawyer, and then also by somebody I know who's a crypto trader, and said, if you think of Ether, so Ether and Bitcoin are kind of the two best known, I would say, right now, currencies, assets, however you want to describe them. And owning Ether gives you access to or Ethereum gives you access to the Ether network. And so the analogy was, if you think about to the days when the internet was being created, if you think back to if you remember the name TCP/IP, or even if you think back to when emails were being created, the @ symbol in an email is a free asset, effectively. But imagine if with email, if you needed to have a token or access to, you have to pay to be able to use that @ symbol. That is somewhat of an analogy of how these tokens could operate to be able to access their infrastructure. You have to pay a fee or have that currency or that token or whatever to be able to send an email. And so once I understood that, I could finally make more sense of it all. What isn't clear, though, and this is from talking to a lot of people as well, is that at one point I was really convinced. I'm like, okay, Ether is it. Like, Ether is legit. And then I was talking to somebody who's an expert, and they're like, oh, no, Ether's over. It's Polkadot now. Polkadot's another one, another asset. So in your world, kind of trying to help create rules around this. I mean, I'm speaking as generically as possible here. How do you do that? And how do the regulators do that? And what particularly have you been focused on?
Well, I think what's interesting in this space is you end up having to really roll it back to first principles. As Evan was mentioning earlier, the space is built for the intellectually curious, because you end up in really almost philosophical discussions as to, what is money, what is a security, et cetera. And I think regulators are really having to do that and step back and look at their purpose and what they are actually, what kind of harm are they trying to prevent and then look at the technology. And it's not always a perfect fit. It can be quite challenging, and it requires, evolving, and it requires as well, engaging with the technology in a way that's quite granular. A lot of the analysis is very fact-based, and, in one circumstance, a token may be a security, but then if held in another way, may not be a security, for example. So we're seeing regulators really having to kind of roll up their sleeves and engage in the space, and there's a lot of back and forth with positions that evolve over time. You have something like the bit license, which was really popular at a certain point in time, and then generally was kind of seen as perhaps too conservative an approach. And so you see regulators kind of shift back and forth. You see it in the most recent guidance from the Financial Action Task Force, where they've essentially scaled back some of the views that they put forward in the initial draft. But you still see something that's at the very early stage of fitting this really brand new technology that has created this explosion of innovation into very kind of rigid frameworks that were built for something very different. So certainly there's a lot of hard thinking and a lot of discussion and conversation and back and forth that happens between the regulators and the regulated entities in this space.
I don't know who would best be able to answer this, but this is something that came to mind when I was, again, trying to wrap my head around the space. Who is trading crypto? It probably sounds like a very simple question, but the reason why I ask that is because there's been such an explosion of interest, particularly since the rally from the lows in May till now. There are people from within the crypto world who have started to kind of rebel a little bit. And so I'm going to butcher his name, but one of the co-founders of Ether, is it Vitalik? Yeah, Vitalik. So I think he's Russian-Canadian. He has come out and said that the system has basically become too financialized. I'm generalizing here because it's such a broad space, it's hard to kind of say anything with certainty but he was a purist from what I gather. And he was worried that it's effectively been corrupted by Wall Street, or that's where it could go. And a colleague of mine who actually covers the market quite well, she was digging around and asking to figure out, who is trading crypto? Is it institutions? Is it largely retail? And there actually didn't seem to be good data, but it could just be that's a Canadian thing. Maybe in the US there is beta data. Do any of you have a sense, and Neil pipe in as well, of how trading breaks down?
I can speak to it certainly on we're a retail-focused platform. We don't have institutional clients, but I can speak to the retail clients. What we see on our platforms are our clients that may be users of our other products who are broadening their investments to include crypto. By and large, they're not investing significant amounts. Actually, the typical exposure is relatively conservative, and they're not trading in and out. Actually, with the data that we see, they tend to buy in a relatively small allocation and stick with it. So not seeing a lot of speculation, not seeing a lot of retail traders necessarily being heavily or overexposed to the asset class. Anecdotally, and maybe I'll defer to others on what they see. Certainly are seeing a lot more professional investors and institutions of a certain sort. I'm not sure we see pension funds trading crypto on platforms, but there's a class of professional investors and traders out there as well, independent of the retail investors that we see on our platform.
Yeah, on our platform, we cater to both retail and I'll call it more professional or institutional investors. We have a product called CoinScore Wealth, which is our OTC desk, over-the-counter trading. We have seen a growth there in terms of notional value. Obviously, not number of clients. Retail is by far away much larger in terms of number of transactions and clients. But we have recently, as it continue, and you hear it in the news of institutional interest, and that includes, and institutional is obviously a really broad word. So that includes everything from family offices, hedge funds, but also corporates. There's a lot of corporates looking at the space, want to do a similar move as a Tesla or Square, where they're moving their cash into Bitcoin, right, to kind of as a hedge against inflation. We do see a little bit of that. So in terms of the data, I'm sure the data maybe exists somewhere in the US, but it's not. I don't have a concrete answer for you, but we definitely have seen as of late. I would say, especially in 2021, more of an institutional push than simply a pure retail push. Obviously, caveat that with the meme coins and stuff, but I'm talking just Bitcoin. A big institutional push for sure.
Right. Okay. What I'll get to next is kind of the...
Can I make a...
Yeah, go ahead.
Make a point?
Yep.
Yeah, I think it's a couple of points. I think as Eric pointed out, there are differences between trading and investing. So I think the larger institutions, corporates, to the extent they get into it, they are investors. Hedging is not necessary. It's a sort of form of a trading strategy, but they're looking to buy and hold for the most part. Traders are normally going in and out, and most of their activity is based around price action, meaning price movements, and typically using a fair amount of leverage because they want to amplify their returns, whereas corporates don't do that for the reasons we understand the risks of using leverage, and it doesn't really fit with the thesis of what they're trying to do with crypto. Number one. Number two, it is very important to recognize that retail trading and investing is now the dominant component of traditional equity markets. And it wasn't in the past, but I think now Goldman Sachs had put out a report several months ago, and this all became much more prominent during that GameStop, that bubble over the summer. That about 60% of trading activity is in retail stocks. Again, traditional equities is dominated by retail traders, and this has to do with demographic shifts. It has to do with the prominence of platforms like Robinhood, other discount brokerages. So that extends directly into crypto itself. Now, crypto trading, depending on the coins, you can look at it regionally. Typically in the past, crypto for years was dominated by retail investors and retail traders, largely out of Asia. Now that has changed to a certain extent based on policy coming out of China. But as was pointed out, the notional value, notional is normally a function of using leverage. So there's the equity that any trader might have in his portfolio, and then is amplified by using leverage, meaning they have exposure to much more of any asset than they would using their equity. So that retail trading still accounts for a fair amount of trading broadly in crypto, certainly in the smaller coins. And that is something that we, and frankly every institutional desk, looks at all the time in terms of like what retail flows look like. And particularly on the blockchain, you can do on-chain analysis and and you can get a sense of not specifically the holders by their identities, but you can look at wallets specifically. And this is one of the beauties of doing analytics on a blockchain, is you can tell where retail traders have entered and exited the market, and you can get some at what price levels I'm referring to, and get some sense of what their threshold for further risk is. On the institutional side, it has grown quite a bit, and this is a function of more institutional type hedge funds, the type that we invest in, coming into the market and trading crypto, and they are in many cases buy and hold, and in many cases purely trading, which is applying strategies that have been used in traditional markets, systematic and algorithmic type trading strategies. And you have, opportunistic and entrepreneurial type of investors that see this as an asset class where they can provide returns to their investors using adapted strategies that they've used in traditional markets. And that seems to work. And that is actually, as was pointed out, becoming much more prevalent in the market.
Awesome. Thanks.
Maybe just to add to that, I would say that there used to be a time that actually buying crypto required a lot of technical skill. You needed your own wallet, and you needed to really understand, where to find it, how to trade it, in a way that perhaps was not accessible to the average individual. Like they didn't really understand this concept of a private key, et cetera. Now you have exchanges where it's much easier to buy it. So I think part of the growth on the retail side has just been because it's much more accessible in terms of actually buying it and finding it than it used to be, as opposed to necessarily kind of a market hysteria. I would actually say the market hysteria was much more pronounced in 2018 when it was like the boom of ICOs. At that point, it really felt like people were jumping in that didn't really know what they were doing. I think now there's a ton of information out there, and people that buy it see it as a worthwhile investment, and they've seen the growth, right? We've got over 10 years of data on the price of Bitcoin, for example, and it looks like a pretty attractive investment from a normal, average retail investor's perspective.
Right. And to the point about how it's much, broadly speaking, safer now. You have custodians, you have legitimate exchanges. Wealthsimple's regulated by the OSC. I think one of 3 or 4 firms now that is. The flip side to that is there's a lot of money to be made by these intermediaries. And so 2 examples would be if you look at Coinbase, which is a major, I guess you call it exchange, in the US, and Robinhood, which is a retail trading app, which has a crypto arm. They both went public, I guess, in the last few months, at least in the last year. So their financial statements are out, and there are huge fees in crypto from facilitating exchanges. Now, some of that is just purely because of volume. But what you're starting to see is here in Canada, I think it was Ontario Teachers Pension Plan, which is one of the largest pension plans in the world, just invested in FTX, I think it is, which is another major exchange in the US. And so you're starting to see this kind of like big money, see those fat margins is the way that I look at it. Where do you think this plays out? Because you're directly in this business, how do you think this plays out? Will there be compression of margin? Will the big players win? Because I mean, the promise of crypto, right, was that we don't need the big institutions, right? Like we can do this all on our laptops, basically around the world. How do you see this playing out, and what's the competitive threat right now?
Yeah, I mean, there are those, you don't need decentralized exchanges to trade. You could use a decentralized exchange, which doesn't have that intermediary. Now, the problem is that the technology to decentralized trade isn't, like if you want to trade as a high frequency trader, for example, you can't really do that on a centralized, you can't do that on a decentralized exchange. It's just not fast enough because you got to use the blockchain. And then you also got to understand how to custody your own coins. And that's also problematic for some institutions as well, or in retail. So we've definitely seen the fees already come down. I think it's very similar to equities, where you're going to see compression. You're going to eventually have the Wealthsimple no commission trading like stock app. It will eventually come to that. I mean, and you have seen it. So I think it's just a matter of really time before, and as those spreads kind of come down, and that's part of the maturation of the space, right? I mean, there are many exchanges globally, and that's what makes this space very different in a way from equities, right? Like there's only maybe 1 or 2 places you can really trade like a Tesla stock or whatever, right? Here there are thousands of venues where you can trade Bitcoin, or hundreds, or potentially even hundreds of thousands. And as you see the industry consolidate a little bit, and some of the trusted players, like really liquidity gets liquidity, you'll see those numbers come down.
Yeah. Another hot topic in the sector right now is AML, which is anti-money laundering. There was been, I'll put it to you this way. Another place where my brain has a bit of a breakdown, or I kind of have a mental lapse, is I think the promise of blockchain, this is the underlying technology, was that everything can be tracked. There was actually a piece done, I think it was by the former deputy head of the CIA, I believe it was, wrote a piece in Forbes saying that this would actually be extremely helpful for anti-money laundering in the long term. And yet we're still at a point where there has been a lot of bad behavior in the market. How would you characterize kind of where we are in terms of kind of getting our heads around that space? And I'll put it to you this way: if you talk to banks, who I know are the enemy of a lot of crypto people, in crypto people's minds, they'll say we've had to spend like hundreds of billions of dollars on AML, particularly over the last decade, and crypto's allowed you to kind of just come out and just run out of the gates. So where are we in kind of having a good framework?
Yeah, so I think it would be misunderstanding the space to think that it's kind of a free-for-all. I think actually the AML regulation in the space is pretty comprehensive, and it takes a real effort to operate an exchange that meets all these requirements. So there's a lot of tools now that are available to essentially do forensics on the blockchain, which, as you said, that traceability actually is very helpful compared to cash. It's way more, way more data rich in terms of understanding money laundering trends, et cetera. And, you've got now guidance at the global level that's been instituted in most large jurisdictions at this point, including Canada, that players in the space are required to register with AML regulators. In fact, a lot of them are dealing with the dual AML regime because they're often securities dealers and money services businesses, so they've got kind of a double set of regulation. So there is actually quite a bit of regulation for those looking to do it in a way that's compliant. There certainly are bad actors out there, and I think the technology always pushes to there are criminals are very innovative in their ability to harness technology. So there's certainly aspects where at the margins where there's a push to try to engage in bad activity, but that the coins, for example, involved in that wouldn't be able to go back into an exchange and cash out to cash without triggering all sorts of alarms. So that traceability really, limits the ability to engage in bad activity. And I would say on the whole, it's a space where there's a ton of work on the AML side that's been done, particularly in the last couple of years, and a huge amount of sophistication in terms of understanding, what's needed there. I wouldn't say, I look at exchanges on this table, and I wouldn't say that, it's an easy thing that they've had to do, and I'm sure they've dedicated a tremendous amount of resources in it.
For sure.
If I can just add to that, I mean, it's also important, I think, to distinguish between anti-money laundering and then other bad behavior, as you put it, like fraud. As Anna noted, every platform like CoinSquare, like Wealthsimple Crypto in Canada has to comply with federal anti-money laundering laws, and we have compliance programs, we have compliance officers, we have sophisticated tools to monitor crypto moving on the blockchain and when it enters or exits our platforms. I mean, that exists. I mean, I do tend to think sometimes the concerns about anti-money laundering in crypto are a bit overblown because, frankly, if you want to launder money, transacting on a permanent public blockchain that any law enforcement agency in the world can access and analyze and trace, it's not a good way to do it. Not that I know much about the business of money laundering, but it's in my view, a bit overblown. The other issue, though, is fraud. I mean, there's absolutely, because there hasn't been a long history of regulation in the space, because there have been bad actors in the space, there's been a lot of fraud, and frankly, a lot of retail investors have been taken advantage of. What we've seen in Canada are the regulators, particularly the securities regulators, taking steps to address that through regulation. And as you noted, we've got 4 platforms in Canada registered under securities laws. There are more that are in that process, and there'll be more. And in my view, that's going to go a long way to addressing a lot of the fraud that has been seen in the industry in Canada. I think one of the important things, though, is that this is a global industry. There are many global platforms who target Canadians, advertise to Canadians, don't necessarily give much regard to compliance with their laws. And that's, I do think, a significant problem. We do have a lot of actors in Canada, platforms like CoinSquare, like ourselves. We're trying to do the right thing, trying to protect our clients. But we also have a lot of platforms outside of Canada who are doing business with Canadians, not always in accordance with the laws that exist here.
Okay, we've got about 10 minutes left. One of the fundamental questions that I've been wrestling with is what happens if let me take a step back. There's a lot of people excited about this space, and understandably so. But a lot of the assumptions about kind of building the future of financial system seems to have this suggestion underlying it subconsciously that the old guard is just going to kind of not wake up, and there's going to be a disruption, and next thing you know, like crypto is the future. Banks, credit card companies, they aren't going to take this lying down. And I would actually argue, because I largely deal with banks, that's kind of my main focus. I would actually say that to this day, they're still pretty asleep to what's happening. There's a general view out there that kind of crypto is just going to go away, at least in Canada. and I've talked to some very senior folks about this, so I'm not kind of just saying this out of nowhere, or they kind of view it as this like sideshow. They understand, they see this trading aspect, they don't actually understand kind of the core of DeFi. To me, one of the biggest risks to anybody who's playing in this space, whether you're running a company or you're investing in it, is that they wake up and the banks create their own chain. And you're already starting to see it a little bit. I think MasterCard has allowed kind of basically processing or putting kind of crypto payments on its global network. I don't exactly know how that works, to be honest. But to your mind, is that a real threat to the promise of crypto? What are you?
No, I actually think it would help with the adoption of crypto. I actually think it would do the inverse, right? Because then those platforms are adopting the technology, right? That then forcing their user base to maybe you try to use the platform, building infrastructure for the platform, and then now it's like, okay, great. So I can have if we're going to like CBDCs or something like that, like a central bank backed digital currency. Or even one of these tokens that they might want to create on their own private network, right? To do that, you still need probably a custodian. You still need an ability to transfer that from one user to the other, do it in a user-friendly way. And that buildup of that technology will then enable other people to like, oh, great, now I know how to use a wallet on my phone to now transact with Bitcoin and Ethereum and some of these other assets. So I'm actually of the view that as more CBDCs and if other private blockchains that come to market, I actually think that will help with the adoption of the space into the true retail general public.
Okay, and from a global perspective, or at least outside of Canada's borders, what would you say kind of the general mentality is right now in terms of embracing it from the traditional kind of Wall Street stance? And I'll give you one anecdote that might help you. There was a CNBC reporter who reported a few months ago saying, I think it was like JP Morgan's traders were saying like, oh my God, the second they let us trade in stuff, like we're just going to create our own markets, and we'll go after the fat fees, and we'll throw all of our scale behind it to create our own chain, et cetera, et cetera. Are the financial institutions kind of outside of Canada, to your extent, quite attuned to what's happening, or is it still kind of people don't quite understand it?
I think it's a mix of both. I think everybody that's paying attention in banking and financial services, which is generally everybody, banks are very good at paying attention to everything in the world. This is what markets are all about. They're looking at all information 24 hours a day, trying to distill that into understanding the world and how to invest in it. But I would say globally, all banks and all financial institutions are looking at it. And I think some of the more astute leaders look back to 20, 25 years ago when you had the advent of the internet. Certainly not in its current form, but you had large telcos that were ultimately completely disintermediated by internet and IP technology. And when the internet itself was introduced, they just had this idea that it was another channel, when ultimately it was the infrastructure for every channel. And we see that now, the way we consume media. It's all done over IP. And it's done via smartphones, tablets, but not through traditional networks the way we used to know them. So I think banks do take a cue from the experience of the telcos, which really, really suffered from that, and have never really recovered in that case. So I wouldn't say all banks are certainly embracing this, but they're all certainly looking at it either to participate or take some type of defensive position to it. But our view, and I think history bears this out, is that markets will ultimately impose their will on everything. Meaning, if people want to trade this, and we've talked about this, the different types of people that are trading. People want access to this. Banks will ultimately want to serve them because there are fees. Whether the fees are going to be in the future as wide as they are now, that remains to be seen. Probably not. But at the same time, banks are fee-generating businesses. And if they can generate fees on any type of transactions and ancillary services, they will do it.
All right. This is a bit of a philosophical question here. but we've got a few minutes left, so I thought I might as well try. This is something that someone explained to me that I had never thought about before, but there's a lot of hype, particularly in the media. We play our part too. You'll see stories around, Bitcoin and Ethereum are at record. I think 2 weeks ago they said a record high, et cetera. And so there's a lot of hype around it all, and that fuels this idea of, FOMO, if you're missing out, everybody's getting rich and you're not, that whole mentality. Is there a prospect that, and this, I get this may sound crazy, but work with me here, that high prices actually are a problem for the system? And I'll say to you this way. So if Ether is the future, if Ether really is the network, or Ethereum, what is the actual network? Is it Ethereum or Ether?
Ethereum.
Okay. Ethereum is the future. And you have to pay $4,000 every time you want to access that system. Isn't that bad? Like, doesn't that fuel, I don't want to use the term inequality, but like how do we kind of have a system that's adheres to kind of the principles about being for everybody and really kind of being this global network, but also makes sense in the kind of speculative markets that we have going on right now?
Well, just a very quick answer. Never underestimate the ability of the technologists in this space to innovate and to address those problems. We've seen a tremendous amount of technological innovation from Bitcoin to Ethereum to other networks. And so you're absolutely right. There are scaling issues on Ethereum in terms of the cost to transact, speeds and issue. But there are also other blockchains that believe they have the developers behind them believe they have a solution to that. And there's ongoing development in Ethereum as well. So all I would say to that is really don't count out the pace of innovation and the ability of the technologies developing these blockchains to address some of the issues that you've identified in terms of cost and speed.
Okay.
There's actually a proposal right now for Bitcoin to I think there's proposals to go all the way down to a Satoshi, but basically the number, the 64,000, it doesn't really matter because you can buy fractions of this, right? You can buy 8 decimal places to a fraction. So there actually is a proposal right now from I don't know who knows if it get passed, but basically in a way it's just move that decimal place down the line. So instead of 64,000, now it's $64. Right? And it's a lot more for the retail investor psychologically. It's a lot more palatable.
Right. Okay. All right. We've got a minute. I don't know if I get another question in. So maybe we'll just wrap it up. So I want to say thanks for taking the time, everybody. Neil, thanks for weighing in. And I appreciate kind of thoughtful responses because quite often I find you can't have reasonable debate in this sector. Is the best way I can put it. And there's a lot of people who are like, if you ask a question, they're like, you don't believe, and it's like, no, I want to believe. Like, help me believe. So appreciate it.
Thank you very much.
Thanks for having us.